Hey, everybody. It has been kind of a turbulent stock market recently. The market, all of the major averages hit all time highs a couple weeks ago, pulled back a little bit after kind of some scary economic data that suggests inflation is kind of being stickier than we thought and the economy is staying stronger than we thought. So, the result of that is now we might have some buying opportunities. The market has kind of pulled back a little bit, and I've done some buying recently. I know Tyler has. So before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from our sponsor, The Motley Fool. It's the best way to support this work we are doing on YouTube. Again, fool.com/Frankel. So, Tyler, let's start with you because you always have the more fun picks, and I'm always curious to see what you bought. With me, let's be honest, it's like I've probably added to my current positions. That's the most likely outcome of my portfolio. So, one, what did you buy? And I'll ask an early follow up question. Is it a new position for you?
It is a new position, and what I bought was Emcor Group. Ticker is EME. This is for somebody who's not a tech person and doesn't have a lot of exposure to AI, whatever. This is probably the closest I'm ever going to become to like an AI investment, because Emcor is one of the nation's largest electrical and mechanical contractors. So basically, anybody that they're the electricians that come in when you need to build a data center or you need to build transmission lines or anything that involves that you need an electrician to do either on a new build construction or actually on existing maintenance on a building. So it's kind of like a built-in, like I think of it like, you know how like General Electric and a lot of these other large equipment manufacturers will then have service revenue after because they're the ones who like perform the services on this equipment. Emcor is not too dissimilar. They'll actually sign out contracts with, data center operators to be like the electrician on call when something goes sideways. And so they have a little bit of the new construction as well as these service contracts on top of it. So with this boom, I guess you will, in construction, either you want to do it for either electrical vehicles or semiconductor manufacturing or data centers for AI, basically anything where we're kind of having this moment of manufacturing renaissance here in the United States. It's been a big boom for Emcor in general. So in the past year, they have what are called remaining performance obligations. It's kind of like a backlog of orders, but it's jobs that'll take more than 12 months to finish. They don't actually tell you like the within 12 months stuff that's going to get done. These are like the really big jobs that they want to do. And for over the past year, the remaining performance obligations went from 7.8 billion to 9.2 billion, giving you an idea of how much work is going on there. And this is a company that, did about $3.4 billion in revenue for a quarter. So and that was up 18% compared to the prior year. For me, this is a business that has shown to be incredibly good at returning capital to shareholders. It's a relatively, it's not the most intense business because basically all of your assets are electricians out in the field. You don't have like a lot of manufacturing facilities or anything like that. The one downside you could say to it is if we do go through a recession, this would be one of the ones that would get hit a little bit harder. But I think with so much of the kind of build out that we've been seeing in terms of energy and all the manufacturing I was talking about, I think there's going to be a huge opportunity for Emcor and some of its peers, but particularly in my opinion, Emcor, that is a reason that I wanted to own this stock. It's not the cheapest thing that I own in my portfolio, but I think with the growth component that it has available to it over the next couple of years, I think this is something I wanted to be involved with for quite some time.
Nice. I'll have to put that one on my radar. I will go ahead and give you two that I bought recently since, they're stocks I've talked about before, so I don't want to give too long of a spiel, but I want to share what I am doing in the market lately. The first one is not a stock at all. It's an ETF. It's the Vanguard Small Cap Value ETF. I've talked about that a couple times. And it kind of hits my two favorite parts of the stock market right now in one investment. Small caps are very undervalued right now, in my opinion. They're trading at their lowest price to book compared to large caps in 25 years. The last time this happened, they outperformed for the next decade or more. Value stocks have really underperformed as well. Most of the gains, most of what's driven the S&P and the Nasdaq to record highs, are large cap growth stocks, specifically tech stocks, and not really the value end of the market, or not really the small cap end of the market is not even in the S&P, but that really has underperformed as well. So that's an index fund I've been building out lately. I've mentioned before that I'm building out index funds in my portfolio a little bit more than I had in the past, just because I have a lot of individual stocks and I want to, start to build kind of a backbone to my portfolio with new money that I'm putting in. The other one that I bought that I feel is kind of really a no-brainer right now is Prologis. Ticker symbol is PLD. That is an industrial real estate investment trust. They're the biggest real estate investment trust in the world. They own 1.2 billion square feet of industrial space. Think, those giant Amazon distribution centers, the buildings where like UPS and FedEx have hubs. It's been beaten down for a few reasons. There's some oversupply concerns, but in a lot of ways, REITs in general are just big victims of the interest rate environment. And I feel like that's definitely the case here. Again, there is a little oversupply concern. There was a time when, Prologis even said, like, we've overbuilt, or Amazon actually, one of their big tenants came out and said, we don't need all the space that we've leased in the past few years. It seems to have caught up now, but there's a few different reasons I like Prologis. There's a couple of forward catalysts that I like. One, e-commerce is still growing. It's only about 15% of retail right now, even less in a lot of the other countries where Prologis operates. And e-commerce just needs a lot of fulfillment space, more so than brick and mortar retail. And Prologis is, and you can call this a good or a bad thing, they're just starting to get into the data center business and they're committing billions of dollars to do it. I think the data center space is very long, has a lot of long tail growth potential, but it also has some big and deep pocketed players who are very good at it. So I think there's potential there, but it's something to watch. And last but certainly not least, there's a lot of built in rent growth in the portfolio. Um, Industrial rent just kind of skyrocketed during the pandemic as demand soared. And because all of these tenants are on long term leases, the average Prologis lease is like 7 years long, give or take. And because they're on long term leases, they're gradually resetting to new higher rent rates. Prologis estimates that its mark to market lease rate or lease spread in its portfolio is 57% on average, meaning that the average lease would have to be increased by 57% to like bring it up to the fair market rent. So we'll see more of that kind of roll into the bottom line numbers. So when you see the valuation, it might look expensive on say like a price to FFO basis, but when you consider all that embedded rent growth, it's really not very expensive at all. And I think it's going to be a big winner. One, as e-commerce grows. Two, as the AI revolution continues, as Tyler mentioned with his play, I like playing kind of adjacent AI things, not direct AI stocks. And I feel like Prologis is a good way to do it. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.